Hi guys, thanks for tuning in to another episode of Nuggets News, and today we welcome back a friend of the channel, and that's Mike from Brighton Capital. How you going, Mike?
G'day, Alex. Yeah, good to be back. Thanks for having me.
Firstly, I've got to thank you guys for supporting the channel a lot recently, and today's episode isn't sponsored or anything, guys, but I wanted to talk about the 90% rule that we're hearing about, and SMSFs have been in the news a lot recently. So, Mike, what's your take on all this? There's a lot of mainstream articles about the ATO cracking down on self-managed supers.
Sure. Yeah, so there were a couple of articles out on, was it CoinDesk and Mikey and maybe a few others last week surrounding this thing called the 90% rule and the 90% diversification rule. So if you have an SMSF, what they were saying was you were not allowed to have any more than 90% in one asset in your SMSF. Now, the most important thing to understand about the 90% rule is that it actually does not exist. So it doesn't exist. There's nothing in the ATO website, any documentation, any of the trust deeds or anything that limits you to a 90% kind of situation. But having said that, it's not, it is obviously wise to be diversified. So Warren Buffett said the only reason to diversify is to protect yourself from your own stupidity. And look, there's not one fund manager in the world that doesn't understand the importance and the benefits of diversification. So definitely important. But there is no really hard and fast rule, really, because it's very hard to police. So what they're really talking about, it wasn't just one asset. So, for example, just Bitcoin. They were referring to entire asset classes. So you can't be exposed to just one asset class. Yeah. And really the hard thing about policing that is you would have to basically go to 99.9% of retail funds. And if you ask them if they're adequately diversified across asset classes, the answer would be no, because they're basically all exposed to the stock market.
So it's probably a case of the media picking up on something and they weren't familiar with the actual rules or laws that they were talking about. But it comes back to common sense, because we hear horror stories about people going 100% in on altcoins or even BitConnect and scams like that. So I guess it highlights the importance of education, doing your research, and diversifying.
Exactly. And if I was going to say what they were actually referring to, so it might be a little bit of a scare campaign to make sure people, don't put all their eggs in the one basket. But there are actually diversification rules in an SMSF. So it isn't a 90% rule, but there is a diversification rule, and that can really be considered more of a guideline. And really what that refers to is the fact that you need to take diversification into consideration, just like you need to take the needs of the members into consideration, or the age of the members into consideration, or how much income they're going to need at a certain stage into consideration. So all these things are important when you're making the investment decisions and running your fund. And when you do have an SMSF, you are in effect the fund manager for your superannuation. So you do need to understand that these responsibilities are yours and the buck stops with you. So really, as long as you are taking everything into consideration and investing for the long-term benefit of the members, then you are doing the right thing.
Yeah, it reminds me a lot about trading, when someone's trying to work out if they're a trader or an investor for tax purposes, and you really have to show that you've done your research and you have a plan, and that's why you have different percentages or trades. So I know that's kind of the picture that I got, where someone really has to know what they're doing and have good reason for whatever diversification percentages they have.
Yes, so absolutely right. And again, when you do have an SMSF, there is actually an investment strategy, which is part of the SMSF, and that needs to be updated over time. Yeah. We include that in all of our SMSFs, and you can change that and adjust that as your situations change. But it doesn't really address specific percentages and actual actions. It addresses the overarching principle that you're doing everything for the benefit of the future version of you, and you're taking into considerations the important things that need to be considered in your situation. So it really does come down to just common sense.
And all those guidelines are on the ATO and ASIC websites for people that want to read more about SMSFs, aren't they?
Yeah, so I'm actually writing a bit of a blog about this, because we've had quite a few of our clients calling up and asking questions about it, which is totally fine. And what I'll do actually, now I'll give you a few of these links that your viewers can actually go and check out the actual wording on the ATO websites and the ATO documentation, just to make sure they understand, what's going on. That's no problem.
Fantastic. Well, for those that are fairly new, because we've probably grown a lot since we last chatted, Mike. So in a nutshell, how's it all going? Plenty of people still parking a bit of crypto, in their super and that sort of thing?
Yeah, so we're pretty much flat out. We brought on 3 new accountants 2 weeks ago. So even with, pretty quiet in crypto space. But yeah, a lot of people are really understanding the idea that you can, in fact, get access or get exposure to cryptocurrencies within your superannuation. And the important thing in regards to what we do is you need to understand if you set up an SMSF through New Brighton Capital, you don't have to be 100% exposed to crypto. You can still buy shares, property, art, jewelry, anything that you're normally allowed within the super environment. You can do through us. And we're just kind of focusing on the crypto space because we think that's where there's going to be, a lot of action moving forward. Maybe we're right, maybe we're wrong. But that's what we're doing. We're pretty busy and glad to be a part of the whole crypto situation.
It reminds me a lot of the crypto tax situation where those accountants that were familiar with tax got a lot of business. And I think because you guys are familiar with crypto, you're starting to drum up a lot of business. Yeah,
so it's us and also Adrian from Crypto Tax Australia. Obviously, a lot of people have been involved in crypto for a number of years, might not be have kept up to date with what needs to be done with that tax side of things. But the reality is, that tax, it does need to be done. And the reality is most accountants either they don't have the confidence in actually doing the work, either the confidence or the competence to actually get it done. And if they don't, to actually get up to speed, they end up actually charging the client the hours that it takes for them to learn. So it's a lot more expensive for them. So if you use services like us or Adrian from Crypto Tax Australia, then obviously streamlined processes is a lot cheaper, and we understand crypto probably better than most other people in the market.
Yeah. I wanted to talk about the macro environment, what's going on in the stock world. And you and I had a great chat a few months ago, and there was a few different sort of investing themes and ideas, but a lot's really changed since then. And the reason that I talk about all this is to protect your nest egg if you are going to have that retirement fund. So how are you seeing the markets at the moment?
Look, last time we spoke, I said that, we're kicking the can down the road. I still thought we're going up in the medium term, but the crash was coming. Still don't know whether this is actually it, but we really have entered the twilight zone with negative interest rates. So the fact that we've gone from 7 billion to, is it 16, maybe 17? Oh, sorry, trillion, 17 trillion in negative interest-bearing bonds it's amazing. This is something that people are going to be looking back in, finance school or just understanding history. It's nuts. 30% of the world's government bonds are now in negative territory. We've never had anything like this before. We have no idea what the effects are going to be. But one of the main things that I'm trying to wrap my head around is the concept of earning interest when you give money to someone. It's about understanding that there's a counterparty risk, and you are entitled to have a benefit for taking on that risk. So the fact that risk doesn't exist anymore, at least in what you receive, means either the risk of holding it yourself is massive, or where else you could put your money, you are pretty sure that you're going to be losing a lot more. So you're very happy to get 95% on your money if you think everything else is going to go down so much more. So it's an amazing time to be. It is a lot to get your head around, but I suppose time will tell.
Yeah, and I don't want to, be a fearmonger, but when you hear about the Ponzi scheme of the bond market and whatnot, I've never really believed in that mantra at all. But at the moment, when there's such a high amount of money chasing negative 1% bonds because they believe that someone is going to buy it off them for a higher price if we go to minus 4%. As soon as governments try the next round of QE, or maybe it's modern monetary theory, and as soon as we get a bit of inflation and the pendulum starts to swing the other way, everyone's going to run for the exits and try and sell these trillions of dollars, as we just said, of bonds. And I don't think there's really going to be a buyer in that situation, and that's what worries me.
I'm really thinking about this a lot, and you're right. But what I'm trying to think about is how the people you've got trillions of dollars going into this, and generally, the house wins. If you go to a casino, the house always wins. What game is actually being played here? And the concept of having negative interest rates really means that it allows people who can't, pay their bills, it allows them to default. It allows them to default very slowly over time, and actually allows them to benefit over time compared to the person who's actually doing the investing. So basically, we're looking at trillions of dollars that are going to be wiped out. Having a look at this might be a bit of a what's the word? Like, I don't want to be too conspiracy side of things. But the thing I've been like, just trying to get your head around what's actually happening here is if we have a crash, and this comes down to, we talked about bail-ins last time we spoke about over a year ago now, and the trajectory of where these rules have been pointing to all points to the fact that people can come in and take the money in your bank account. So just to give you maybe a 20-second kind of rundown for people who aren't familiar of the rules that have actually changed. Now, I'll be talking about what's happening in Australia, but these rules have been happening all across the G20. So if you're in Canada, US, New Zealand, it does apply to you. So basically after the GFC, it's a bit of a reshuffling of what the rules were. And you used to actually have a bank guarantee. So if you actually had money in a bank account, the government would guarantee it for up to $1 million. So if the bank went under, you were going to get your money back. It was actually insured. After the GFC, a couple of years after, 2012, they took that $1 million and now they put it to 250 grand. All right, so $1 million to 250. And then they actually put a limit on how much could actually be paid out in the event that there were massive losses. That amount is capped at 20 billion. Sounds like a lot, but it's actually 1% of the deposits in banks in Australia. So it's really not a lot. So if this happens, odds are you're probably not going to get money. But even more, not only are you not going to have your deposits guaranteed, these bail-in laws allow the banks to come and take your money if they're into trouble. And the new laws allow the government to come in and take your money if they're into trouble, and also extends that reach to overseas banks or overseas governments claiming an emergency and being able to come in and take money out of an Australian bank account. So you could have a European bank that turns to the Bank of International Settlements and says, hey, we're in a bit of strife here. We need to declare an emergency. The Bank of International Settlements can send out an email to the main governments and the banks, and all of a sudden, everyone in the G20 gets a 5 or 10% haircut of their funds or more, who knows. Now, this is actually written into banking legislation now. And I'm not saying this is going to happen tomorrow or whatever, but the fact that it exists is phenomenal and alarming, and it just makes sense to actually have a certain proportion of your assets in something that can't be confiscated. So whether that's physical assets or something like Bitcoin or whatever else.
How does self-managed supers fit into the bail-in laws, Mike?
There was question in regards, so specific retirement accounts were actually, money could be taken out of them with Canada and New Zealand. It was ambiguous in the Australian legislation, which means yes, it could be. So the answer is, if you've got money in a bank account, it can be up for grabs. So it's not just money; it's also money in term deposits in banks.
Yeah.
And these supposed guarantees, even though they don't exist, if you're a small business owner, you might have a couple of $100,000 just for your own, cash flow. And a lot of retirees who have self-managed super funds, to take the lower risk option, they do accept these. Generally speaking, they used to really have a high proportion of their assets in these bank term deposits, which were returning maybe 4 to 6%. Now they're getting maybe 1 to 2%. Yeah. So they're getting a lot less for their money, and they are in effect taking up a lot more risk because all the guidelines, all the rules are now in the bank's favour.
Yeah. I just wanted to go back and unpack that statement you said before, because it's probably something that we haven't spoken a lot about. And that's deeply negative interest rates, where that debt gets paid off for you over time. So if interest rates go to negative 10%, then my mortgage is getting eroded 10% each year. And that's, I guess, the final solution. So in some ways, it's good for people with a lot of debt. But I guess the flip side I always tell people is, if that happens, people are losing their jobs everywhere. And there's a lot of other things you've got to worry about, other than the fact that your debts might be 10% lower.
Yeah, well, we've actually got a real life case, like a real life scenario happening in Denmark. So they've got negative 0.5% for your mortgage. You can take out $1 million loan. You have no repayments. You just have to pay back 95% of the principal after 10 years. So what's that going to cause? Probably massive bubbles, but probably bigger bursts. Again, it's lunacy. And we'll find out. But it's really just about, I suppose, as much as you can, understand the game that you're playing. Because whether you realise it or not, we're all playing the game. We're all in the game. We all are invested in certain things. And again, that's just something where diversification is probably a good idea into something that is maybe a provable scarce asset.
Yeah, and I guess that's why we've been pretty passionate about education, because it really has become relevant the past 12 or 24 months, the game that is being played. And even if it's only a 1%, 10% chance of this happening, if you know what to do and you have a sort of bit of an exit strategy or just to rotate your assets into what you think is going to protect you best, that's the way to go.
Yeah, and just trying to think about why, they're trying to do this scaremonger in regards to crypto. And obviously there were a lot of scams. You need to look after, what you're doing. But at the end, what not only Australia but the world is going through right now is pretty much a crisis of having less money being pushed into the stock market by a working population. So you've got the baby boomers, and now, really they're stopping work, they're retiring. Not only are they not contributing to the stock market now, they're actually taking away every week, every month.
Yeah.
And the other main contributor to the stock market over the last number of years hasn't really been the general population. It's really been buybacks financed by corporations buying back their own stock.
Yes.
So these low interest rates obviously benefit them. But if you have less people putting money into the stock market, the government obviously want to stem that flow of how much money is being pulled out, because it doesn't matter how good the economy is going. If people are pulling their money out, stock prices are going to go down.
Yeah.
And governments want to make themselves look good and show on the paper that yes, things are going up and all the rest of it. There's a lot of havoc coming ahead, and it's just about educating yourself.
It's not really a market anymore, is it? Like, you think about Japan, when they own something like 90% of the ETFs. So what happens when governments own 100% of assets? It's not really a market with a true buyer and seller anymore. So it makes you wonder where this is all going.
Yeah, central banks were never supposed to have any vested interest in the stock market. They were just supposed to be the lender of last resort. They weren't supposed to have anything on their books. The fact that they're literally going in there and buying, it's whatever they want to do. So you just need to pay attention to where that big money is going. At the moment, it's going into negative bonds. All right, well, maybe it's worthwhile spending a bit of time and learning about that side of things.
Well, it's been a bit doom and gloom today, Mike. Any final notes you want to finish on, maybe a little bit more positive?
I suppose it's just, look, even though you can make a lot of money in a crash, but the thing is, with a retail super fund, they're not allowed to buy, they're not allowed to sell assets. You're not allowed to short the market. But with a self-managed super fund, you can't, even though you can't short the market and you can't have any debt, you can actually buy assets that are inversely correlated to shares. Yeah. So you can buy, triple short against the S&P or some other ETF which goes up when everything else actually goes down. Yep. So, that's just another way where you can also buy bonds within your SMSF to take advantage of this, if this kind of booming bond market continues. And again, being diversified into other assets, whether it's property or precious metals. So gold you can buy within SMSF, or crypto, or, so even though there's a lot of uncertainty ahead, there's a lot of money to be made during these times. If you're well educated and you execute correctly. So it doesn't have to be all doom and gloom. You just need to understand, again, the game you're playing and prepare yourself accordingly.
A lot like the crypto market, even if we do have a deep crash, there's going to be good buying opportunities during that phase as well, isn't there?
Yeah, and these, it's not about, I'm going to have a crack at this and see if I can make X amount in 6 months or whatever. You need to be thinking long term about the game that's being played again. And really, on the crypto side of things, well, my thesis at least is the fact that there's no version of the future where this technology does not fundamentally underpin how the world stores and transfers value.
Yeah.
So just the understanding that money is half of every transaction on the planet, and the fact that we've got billions of people who don't have internet access at the moment and they don't have a bank account. But in 5 years, every one of them will still not have a bank account, but they will have a mobile phone. So just understand that these things are coming. It's not about trying to be, hit a home run overnight. Just understand the big game that's happening in the macro space. Do your research and just start the process. You don't have to start setting things up right now. Just if you understand that there's really something that's worth learning about here, start learning. Whether it takes a month, 6 months, a year to really get your head around about what's happening and how you want to approach it, great. But just start the learning process. That's what I'd say.
And you guys do have a free consultation. So thanks again for supporting the channel, Mike. I'll put the links in the description below, and we'll have to catch up again soon.
Okay, great. Well, thanks for having me. And yeah, we'll see you soon. Thanks, Nugget.
Cheers, guys.